Today we are going to talk about the treatment of losses for taxation purposes. Imagine you are the manager of a corporation whose expenses exceed its revenues in the current period. Consequently, your corporation incurs a loss. Now you wonder how losses are treated for corporate taxation purposes. Generally, corporate profits are taxed in the year they are incurred. Thus, in good times, the government receives tax revenues and thus participating in the profits of your corporation. Principally, in bad times, the government should then also participate in the losses of your corporation. This would require your corporation to receive a tax refund in the loss-making period. However, countries do not allow for an immediate tax refund. Instead, your corporation may be able to offset its current loss against its past or future profits, depending on the country's loss offsetting rules. We distinguish between two different loss offsetting rules, the so-called loss carryback and loss carry-forward. If a country allows for a loss carryback, your corporation can deduct its loss from profits of past periods. A loss carryback thus reduces the tax payments of preceding years, and your corporation receives a tax refund in the current year. Hence, it is comparable to an immediate tax refund and results in a liquidity boost. From a country's perspective, it has the advantage that the tax refund is limited to the corporate tax payments in previous periods. Countries can further limit the periods and amounts of a loss carryback. If a country allows for a loss carry forward, your corporation can deduct its loss from profits in future periods. A loss carry forward does not result in an immediate tax refund, but reduces the future tax burden of your corporation. Importantly, if a country allows for only a loss carry forward, your company might face a liquidity constraint in the loss-making period as it does not receive an immediate tax refund. In addition, if your corporation never generates a profit in the future, the loss carry forward is ultimately lost. Countries can limit the periods and amounts of a loss carry forward. If a country allows for both a loss carryback and a loss carry forward, the loss carryback usually takes precedence. That is, only if a loss cannot be fully offset against the profit of previous years the excess loss amount is carried forward. To summarize, for taxation purposes, corporate profits and losses are treated asymmetrically. While corporate profits are taxed immediately, losses do not result in an immediate tax refund. Still, they can be carried back or forward to be offset against profits of other periods. However, limitations on loss offsetting may sometimes prevent full loss compensation.